Imagine a snack and drink giant like PepsiCo not just meeting Wall Street's high expectations, but smashing them despite some real headwinds at home. That's the exciting reality from their latest earnings report, and it's got everyone talking about the future of big brands in a changing world. But here's where it gets controversial. Is this international success just a temporary win, or a sign that PepsiCo is pivoting away from its American roots? Stick around, because we're diving deep into the numbers and the nuances that most headlines miss. PepsiCo, the powerhouse behind iconic treats like Doritos, Quaker Oats, and of course, Pepsi itself, released its fiscal third quarter results on Thursday. The big news? Their earnings and revenue blew past what analysts had predicted, thanks largely to booming sales in markets outside the U.S. This international boost helped balance out another period of softer demand right here in North America. For beginners wondering what all this means, think of it like this. Earnings per share, EPS, is basically the company's profit divided by its shares. It's a key measure of how much money each shareholder gets. Revenue is the total money coming in from sales. PepsiCo's adjusted EPS came in at $2.29, edging out the expected $2.26. While revenue hit $23.94 billion, surpassing the forecasted $23.83 billion. To put this in perspective, let's break down the financials a bit more. The company's net income for the quarter was $2.6 billion, or $1.90 per share, which is down from $2.93 billion, or $2.13 per share compared to the same time last year. But when you exclude one-time items like special charges or gains, that adjusted EPS of $2.29 tells a brighter story. Net sales climbed 2.6% to reach $23.94 billion overall. And if we strip away the effects of acquisitions, divestitures, and currency fluctuations, known as organic revenue, that growth was still a solid 1.3%. This organic figure is important because it shows the real, underlying performance, without external factors muddying the waters. However, not everything was smooth sailing. PepsiCo's global volume for both food and beverages dipped by 1% in the quarter, after accounting for pricing and currency changes. Volume here refers to the actual units sold, like cans of soda or bags of chips. It's a direct indicator of consumer demand. And this is the part most people miss. While international markets are thriving, perhaps due to emerging economies embracing Western snacks or local flavors blending with global brands, the company is grappling with weaker appetite in its home turf. In North America, Pepsi Foods North America, covering brands like Doritos, Quaker Oats, and Pearl Milling, saw volume drop 4%, and the North American beverage unit, think Pepsi, Gatorade, and more, shrank by 3%. Yet CEO Ramon Laguarta highlighted improved momentum in beverages, suggesting strategies like targeted marketing or product refreshes might be turning things around. For example, imagine Gatorade launching new flavors tailored to fitness trends. That could be sparking renewed interest. In response to these domestic challenges, PepsiCo is doubling down on investments in its brands and exploring ways to cut costs, like streamlining operations or renegotiating supplier deals. This raises a controversial point. Are these moves enough, or is the company risking its iconic status by focusing too much on efficiency over innovation? Critics might argue that cost-cutting could lead to lower quality products, alienating loyal fans, while supporters see it as smart business in a competitive landscape. Looking ahead, PepsiCo stuck to its full-year outlook, expecting core constant currency EPS to stay roughly flat compared to last year and organic revenue to grow by a low single-digit percentage. Constant currency means adjusting for exchange rate changes to get a clearer picture of true performance. And in a surprising twist, the company announced that Chief Financial Officer Jamie Caulfield is retiring, with Walmart's U.S. CFO Steve Schmitt stepping in effective November 10th. This leadership change could signal a fresh approach to navigating these global shifts, maybe bringing retail expertise to boost supply chain efficiencies. So, what do you think? Is PepsiCo's international strategy a masterstroke for long-term growth, or should they prioritize fixing the North American slump before it's too late? Do you believe cost-cutting measures will pay off without hurting brand loyalty? Share your thoughts in the comments. Do you agree with their outlook or see a different path forward? Let's discuss.